Welcome friends to the third edition of BCAS TAX GURU-COOL. This is an initiative by Bombay Chartered Accountant Society and the Direct Tax Committee of BCAS. This is a monthly update of all the tax events which happened in the last month. Today we have CA Saroj Maniar as our guru who would be enlightening us on all the past events which happened in the month of August.
Thank you, Kinjal, and thank you to BCA for this opportunity. Hello, friends. It's my pleasure to present to you the developments in the month of August in the direct tax field in a capsule format. August has kept us busy doing the tax audits. Most of us try to do a major of the tax audits by 20th August in the old format, but those of us who haven't need to spend a lot of sleepless nights doing the tax audits in the new format. Various representations have been made to the CBDT for either amending or postponing the new reporting requirements. Small relief has been granted by Circular number 6 dated 17th August 2018, whereby Clause 30C pertaining to the GAR, the General Anti-Avoidance Rules, and Clause 44 pertaining to the GST compliance of the tax audit report have been kept in abeyance till 31st March 2019. So all reports that we sign up to 31st March 2019 will not have reporting under these two clauses. The updated tax audit form along with the schema is available for e-filing, but that also contains these two clauses where we will have to write not applicable. August onwards also keeps us busy for scrutiny proceedings. The tax department since 2015 has started a pilot project for e-scrutinies. Thereafter, they extended it on a voluntary basis in a number of metros. In 2017, the tax department has developed an income tax business application, which is a platform which is integrated with the SSE's e-filing platform. Last year onwards, the CBDT came up with an instruction that all the scrutiny proceedings would be conducted electronically, and the concept of manual scrutiny was it was tried to make it redundant. CBDT now has come up with an instruction number 3 dated 20th August 2018, wherein it has stated that conduct of assessments through manual proceedings will be possible under certain circumstances. Those would be search and related cases, reopening, best judgment assessments, set-aside cases, taxpayers who do not have a PAN, taxpayers who have filed a paper return and don't have an e-filing account, cases at locations which are connected through VSAT and have a low connectivity, cases where substantial hearing has taken place manually prior to the issue of the February circular, and various exceptional circumstances such as complicated cases or there are administrative difficulties in receiving the data through the e-platform. In addition, what the circular also says that personal hearing can take place in addition to the e-proceedings in some of the cases. So for example, where books are required to be examined, where the examination of witnesses or the cross-examination is required by the assessee or the assessing officer, where the assessing officer invokes provisions of Section 131, or where a show cause notice is issued stating as to why certain additions should not be made and the assessee has requested for personal hearing. However, all this data is also required to be uploaded online and be kept on record through the e-filing portal. Next is the tax department, in order to reduce the litigation backlog, the CBDT had come up with a circular saying that the tax department would not file an appeal where the tax effect was below certain thresholds, and those thresholds were for ITAT appeal 20 lakhs, for High Court appeals 50 lakhs, and for appeals to the Supreme Court 1 crore. That certification is sought to be modified slightly, and the tax department the CBDT has given leeway to the department to file an appeal in certain cases irrespective of the amount of tax effect. So where the constitutional validity of the provisions of the Act rule is under challenge, where the CBDT's order notification circular is held to be illegal, where the revenue audit objection has been accepted by the department, and where the addition relates to undisclosed foreign asset income. These exceptions were already there in the earlier circular of July. The new additions are where an addition is based on the information received from other sources such as enforcement and intelligence agencies such as CBI, Enforcement Directorate, DRI, SFIO, or GST intelligence, and pending cases where prosecution has been filed by the department. Next is the clarification by the department on the immunity provided under Section 270AA. The scheme for penalty for concealment has been amended, and now the term used is underreporting of income. Penalty at the rate of 50% of tax other than for misreporting is sought to be levied. However, an assessee may apply for immunity by making the entire payment of tax and by undertaking not to file an appeal. The concern that the assessees had was whether such application for immunity would weaken their case for penalty in the earlier years in respect of 271(1)(c). The tax department has clarified that such an application for immunity will not preclude the assessee from contesting the same, and that the tax department shall not take an adverse view in the penalty proceedings in the earlier years only on this ground. Another recurring issue has been the definition of export turnover and total turnover under Section 10. Export profits for the purpose of deduction are determined in the proportion of export turnover to the total turnover. The tax department in a number of cases have been reducing the amount of freight, telecommunication charges and insurance expenses from the export turnover because the section provides so, but do not do the same when they are determining the total turnover. So this leads to a smaller amount of deduction. The Supreme Court in the case of HCL Technologies has held that the reduction from export turnover, the amount which is reduced from the export turnover should also be reduced from the total turnover while working out the admissible deduction. The department has now, the CBDT has now asked the department to either withdraw the appeals which have been filed on this account or not to press appeals on this issue. In view of the disruption caused due to several floods, there has been an extension of due date for filing the ITR from 31st August to 15th September for Kerala assessees who are liable to file the returns. Let us now come to certain important case laws that have been reported in August. There have been various interesting decisions, but we will restrict ourselves to 4 decisions which we thought would be of general interest. The first one is a batch of about 30 appeals before the Supreme Court. This was in the context of deduction under Section 80 IC. The case was that the assessee had set up a new manufacturing undertaking in certain backward areas of Himachal Pradesh. The admissible deduction to the assessee was for 10 years. For the first 5 years, it was 100%, and for the next 5 years, it was 25% for non-corporates and 30% for corporate assessees. The assessee had carried out substantial expansion in the 6th year or after the 5th year and sought to claim 100% of the deduction. The Supreme Court, while interpreting Section 80 IC, has stated that 80 IC grants you 100% deduction only in the first 5 years starting with the initial assessment year, and year 6 or year thereafter cannot be considered as initial assessment year. So the deduction would be restricted to 25% or 30% as the case may be for the next 5 years. The next decision that we would like to talk about is the Supreme Court decision in the case of Monat Ispat and Energy Limited. This was a case which has reference to the Insolvency and Bankruptcy Code. The Delhi High Court had earlier held that the moratorium available under the Insolvency and Bankruptcy Code would also apply to the order of the Income Tax Appellate Tribunal in respect of the tax liability of the assessee. The tax department had sought relief from the Supreme Court. However, the Supreme Court, referring to Section 238 of the Code, stated that the Code would override anything which is inconsistent with any other enactment, including the Income Tax Act, which means in respect of companies which are falling under IBC, the tax department would not have recourse to the tax dues, even though tax dues, being in the nature of crown debts, would normally take precedence. Another important decision was in the case of Sunrise Academy of Medical Specialties India Private Limited versus ITO of the Kerala High Court. This is again a very topical issue that all of us face from time to time. In this case, the assessee had received share premium and he had explained the source and the genuineness of the share premium and had contended before the AO and the subsequent authorities that in terms of Section 68, it could not be taxed since the source genuineness was proved and explained. The Kerala High Court has said that looking to the provisions of Section 56(2)(7)(b), the excess share premium received by the taxpayer, despite all the satisfactory explanation, would be liable to tax. If the satisfactory explanation would not have been offered, the entire amount would have been liable to tax under Section 68. But just because the explanation is offered, it does not mean that there would be no tax implication under Section 56(2)(7)(b). It even sought to explain the difference in circumstances where such amounts would be taxed under Section 68 and where such amounts would be taxed under Section 56(2)(7)(b). The next decision that we would talk about is a Delhi ITAT decision in the case of Consolidated Securities Limited. This addresses a practical issue of MAT tax credit that we all come across from time to time. The question faced very often is whether the MAT credit would be inclusive of surcharge and cess, or it would be only of the tax amount paid. The ITAT has held that surcharge and cess is a part and parcel of tax and both have to be considered in a consolidated manner. Otherwise, it is possible that the assessee may lose out the benefit because every year the amount of surcharge and cess varies. So when the interest under 234A, B, C has to be determined, the entire amount of MAT credit inclusive of surcharge and cess has to be reduced and the balance amount payable would be liable to interest. Thank you, friends, for tuning in.
Thank you, our cool guru, Saroj Maniar. That was quite a crisp and lucid update of and snapshot of last month's tax issues. So stay tuned for the next month's video, and the team at BCAS Tax Guru-COOL would love to have your feedback. So please feel free to post it on bcastaxation@gmail.com. Thank you.